Hi, everyone. Welcome to the show. Today we have a very special guest, and that's Brett Gardner. Brett's the author of a book called Buffett's Early Investments. This is Brett's first book that he's ever published, and it's one that really needed to get out there, and I was super curious to read it and curious to know about Buffett's early days. There's not a lot of information out there, and the information out there is very hard to get and to grasp and to summarize. So, Brett, you've done a fantastic job. Thank you.
Thank you. I really appreciate it. And thanks for having me.
And so, we were talking a little bit before the show. Uh, Buffett's partnership started with something like 300,000, and he was able to grow that by the time he closed the partnerships. Total assets under management were right around 100 million. So he grew these partnerships from 300,000 to 100 million. His annualized return was right around 29% in the partnerships. Buffett has said on record, though, that before the partnerships were even structured, when he was investing his money, his dad's money, and people close to him, his returns were up to 50%, which is just phenomenal. And not many people know about this extreme outperformance. We know Buffett of today, who invests in a lot of companies like that you found on you'd find in the Dow Jones Industrial Index, and they're steady eddies. So what inspired you, Brett, to write the book in the first place?
Sure. So I started researching these companies about 7 or 8 years ago, just because I was interested in learning about business history and trying to figure out what Buffett was seeing when he started analyzing these companies. And I had like no intention to write a book actually. And then there were two I stumbled upon: Philadelphia and Reading, which was a pre-partnership investment, and Walt Disney Productions, that led me to choose to write the book. So in my view, Philadelphia and Reading was in some ways a predecessor to Berkshire Hathaway, where it was Buffett's largest personal position, and his mentor, Ben Graham, was on the board and enacted change to create value for shareholders. And there were a lot of parallels between Berkshire and Philadelphia and Reading. And I don't think people really understood the story. And then on Walt Disney Productions, I came across this corporate governance issue with Walt that I thought was really interesting and has never really been spoken about publicly. And I thought these two stories were just so interesting that I felt like they had to get out there in some form, which led me to decide to write.
If we explore the Philadelphia and Reading story, which is super interesting, so his mentor Graham was involved and was very much an activist. That company, was that a coal company?
Yes, so when Buffett first invested, it was an anthracite coal company, and anthracite coal was used for home heating, and it was a major energy source at the turn of the 20th century. I think it was responsible for like 20% of America's energy production, and that was going away as oil and other fuel sources supplanted it. But when Buffett first bought the stock in 1952, it was just an anthracite coal company.
And so it was the catalyst that the Buffett understood, right? That it would be transforming to more of a conglomerate, and he understood the vision of Graham and other shareholders, right? He took a stake in the company.
Yeah, so I think that when Buffett first bought the stock, he was still a stockbroker in Omaha working for his father, and he didn't know what would happen with the company. So he bought the stock because it was traded below tangible assets. So it had about $30, a little north of $30 of tangible assets on the balance sheet. The stock was trading at $17. So he bought a little bit of it in 1952. And then a couple years later, he was working for Graham Newman, and he made his biggest personal position. By this point, the stock had dropped to $9, which was roughly net current asset value. Buffett thought that there was some off-balance sheet items that were worth about $8 a share. So he thought it was worth at least 17. Stock was trading at 9. He put about a third of his portfolio into the company. And at this point, again, he was at Graham Newman, listening in, hearing Ben Graham and Jerome Newman and Mickey Newman talk about the company. And he was quoted in the Snowball saying, "I was like really curious on what was going on. It seemed like something was going to happen." And even though I don't think he knew what would happen, he knew that Graham was going to do something.
Super interesting. So explain the parallels between Philadelphia and Reading and then Berkshire later that the Buffett acquired shares and then ultimately took over the entire company. Tell us the
Sure,
parallels.
sure. So most obvious is it was a declining industrial company trading at an attractive valuation. So Berkshire was a net net when Buffett bought it. Philadelphia and Reading was a net net when Grandma and Buffett made it such a big position. Then there was the intervention by the investor, meaning in Philadelphia and Reading, Graham intervened, and in Berkshire Hathaway, Buffett intervened. And then when they took control of the company, they used very similar strategies of using their network to find good deals. For example, Philadelphia and Reading, first deal was done at an insanely attractive valuation because the founder of Union Underwear, the company that was acquired, became friendly and fond of Mickey Newman, who was spearheading these efforts on behalf of Philadelphia and Reading. And Buffett subsequently used his own likability to get some attractive deals. There's also the fact that both Mickey Newman and Warren Buffett are fundamentally high integrity individuals, and they use that as the basis for a sprawling conglomerate. The next is, I'd say, they use some creative financing to create value. Mickey Newman led the efforts to write down the value of the coal lands to create an NOL and shield Philadelphia and Reading from taxes. So there are all these creative ways that they went about it. And it's kind of funny. One thing that I didn't realize before I started writing the book is that Buffett actually helped source a deal for Philadelphia and Reading when he was running the partnership. He had a position in this company called Lone Star Steel, and he called up Mickey Newman, who had a larger balance sheet as a function of being the head of Philadelphia and Reading, and told him, this looked interesting. So Philadelphia and Reading then took over the company. And Buffett, again, used that same type of tactic of using his network to find deals both in the private and public markets.
Interesting. So it was absolutely an inspiration for Buffett to acquire Berkshire, which went from textile to conglomerate. Philadelphia and Reading went from coal to conglomerate, and Berkshire became his permanent capital vehicle, basically, right, to go out and to acquire all these other companies, as he still does. That's super interesting. Tell us about the research process, Brett. I heard that you made the basement of the New York Public Library your home for a while. So just tell us how you went about researching and what sources you used for the book.
Sure. So it's kind of a funny story that the library that I started researching this actually shut down, and they changed to a much more expensive building across from the famous Schwarzman one at 42nd. So the work really started on the microcard and microfiche machines in the basement of the New York Public Library on 34th Street, which they subsequently sold the land and shut that one down, which I miss. And then I stumbled upon this service called Merchant Archives, which has them on PDF form. New York Public Library has access to it, and I think a lot of local libraries do as well. And that made it much easier because I didn't have to go through the microcard and microfiche machine. And then as I decided that I wanted to actually write the book, there were a couple companies in particular that I didn't think were well covered. So I started calling up local libraries, libraries that were local to the companies that were oftentimes now defunct, and see if they had any documents. And this let me stumble upon the Hochschild-Kohn annual reports, which was the first deal Buffett and Munger did together. First formal deal. I think they had some overlap in stocks prior to that. And I just kept pulling on that thread. I ordered a bunch of books. Disney was probably the most labor-intensive chapter, where I probably read 30 or 40 books on rather Walt Disney himself or the movie studio industry. But I just kept trying to pull threads, and there's actually a lot of research. For example, in Philadelphia and Reading, there's a bunch of books on the history of the coal industry because it was so important to the country. And within the footnotes, there's sources of documents. For example, there were bankruptcy documents related to Philadelphia and Reading that I was able to find, and I just kept digging and digging, and I always found more than I expected.
Now, Buffett's home, Oklahoma, does it have any archives? Does a public library there have a special section on Berkshire?
Oh, Omaha, I think.
Sorry, Omaha. My bad. Okay.
Yeah.
I stand corrected. Sorry.
There were a couple of pictures of him that I found. I actually wanted to use one on the cover, but I needed his signature. There's some Nebraska state law that requires the permission of the person or their family before using their image for like public work. So I wasn't able to use that. But I don't think that there was not a repository of documents related to Buffett in Omaha yet.
Yeah, exactly. Early on in writing the book, I think you actually contacted Warren Buffett. Is that right? At his office.
Yeah. So I actually wrote to him way before I decided to write, back in I think it was 2018, and I asked him for a memo he wrote on Cleveland versus Mills, and I got a letter back from his assistant saying it was in dead storage, but to check security analysis. Sure enough, it was there. And then when I decided I was actually writing, and I was far enough along where I had a bunch of questions for him, I wrote him a letter. I sent him some documents, and I asked for an interview. I actually didn't think he was going to respond at all, and then it was kind of funny. Like, I get the notification that my FedEx package got there at like 2:00, and then 3:30 I get an email titled like "From Warren Buffett," and it says something to the effect of, "This is a very interesting project, the type of thing I would have done when I was far younger. I can't do an interview, there's too many requests, but good luck," which I was stoked about.
That's really awesome. And afterwards, though, when the book was published and you had the printed copies in your hands, you ended up sending, I think, 2 copies to Buffett. And tell me what happened after.
Yeah, so I sent 2. I sent him a one-page letter, detailing the project and thanking him for being an inspiration. And I asked for him to sign a copy back, and sure enough, a couple days later, I got one FedEx back. So
that's really cool. I'm sure that was like a childhood dream, right? Coming true. Like, you got a signed copy of your own book back from Buffett.
Yeah, it's kind of funny. Like, I was like, it's kind of a weird request to ask somebody to sign your own book, but I think that considering the subject, I think it made sense. And I had a little anxiety because I didn't. Because I don't think he read it, to be clear, but I was like, maybe there's something in there he doesn't like, and he's not gonna reply, or maybe he doesn't like the image I used of him. So there were all these downside cases that I ran through in my head, but he was gracious enough to sign one back.
I'm sure the book is on his bookshelf right now. I can almost guarantee it. Now, take us. There's really 3 phases to Buffett, right? There's pre-partnerships. Then there's the partnerships, and then there's him taking over control of Berkshire, and then the rest is history. Take us to Buffett's early investments and his investing style pre-partnership, if you can.
Sure. So he was pretty much a what I call like a deep value net investor. Almost all his positions were net nets. The ones I write about in the book are all net nets. There are a couple of special situations that he does as well. There's one story that's covered really well in Snowball, called Rockwood, where it was basically like an arb that he sticks around for because he trusts management. But he's pretty much like solely a net investor. And then he kind of gravitated towards more activist in the partnership. He had a bigger balance sheet. He saw the success of Union Street Railway, which had some element of soft activism, and then Philadelphia and Reading. And he deployed that strategy within the partnership. Companies like Dempster Mills, Sanborn Map, which he wrote about in the letters, which is why I chose not to write about them. So there's a lot of this activism, because one of the things that he did in his partnership is he had these 3 categories called generals, workouts, and controls. Controls being basically activist situations. So I kind of classify him at a high level within the partnership as very much a quantitative investor with some activism. And then importantly, I'd also add that he did a lot of these special situations, like these workouts. I write about one called British Columbia Power, but these positions were often like about a third of his portfolio, and he used a little bit of leverage to maximize the return. Not a lot, to be clear, but he used a little bit to maximize the return. And this is an important element of his portfolio management, which allowed him to earn returns when markets as a whole were down. And then, you brought up the point that he shifted a little bit when he was in Berkshire, and you start seeing elements of this in the partnership with, first I think American Express, which was a great business, and then with Disney, which was kind of a weird business where you kind of see him like analyze the company through the balance sheet, despite future returns being predicated on the cash flows. So you start seeing this pull towards investing in better businesses later in the partnership. And then he did much more of that in the 70s, 80s, and onwards.
And Buffett's work ethic was unmatched. It remains unmatched. He's always reading, and he would love going through Moody's, right? Like he would just go, he would comb through. Tell us more about his research process.
Sure. So the Moody's manuals, which are quite thick,
Yeah.
I read through them at the New York Public Library, and they're really thick, long, small type. They're hard to read. He used that as a filter for doing more work, meaning he'd read Moody's manuals and find stocks to research. Like that was just like the first filter for him, is finding something cheap. And one of the things that I try to convey in the book is that he did a lot of the scuttlebutt detective work, and was not just reading. He did the reading and the detective work. And first on the reading part is he also like hunted for data in very interesting ways. Like for example, he was like known to go to like insurance to insurance regulators and go to their basements and like look through old filings. Graham also actually did some of that too, I believe. So he was on the hunt for data. One last anecdote on this is Schroeder talks about this in Snowball, where he like went to Dempster Mills with like a list of questions, and this was like in the 50s, and like one of his questions was about bad debt expense during the Great Depression. So he's always looking for these like longer data series than I think is like commonly known. And second, on like the detective work, going in, I had an idea that he did this, but I was actually struck at how frequently he performed this type of research. Meaning, like the most famous story is that when he was 20 years old, he took the train down to Washington D.C. to meet the future CEO of Geico, but he did that pretty consistently throughout these years. Thinking about the first half of the book, Marshall Wells, he goes like to the annual meeting. Cleveland versus Mills, he flies out to Ohio to go to the annual meeting and confront them about a dividend cut. Drives to New Bedford to meet the president of Union Street Railway. Later on, he goes and meets Walt in Anaheim. So he really did this like tenacious creative research that I don't think I knew the volume of prior to embarking on this project.
And I think in your book you also mentioned that he went to count rail cars at one point as well, part of his research. Tell us about that.
Yeah, so there's a little bit of dispute on whether it was him or he sent somebody to do it. And I put this in the footnote at the bottom of the page because to make it clear I wasn't sure, but I think it was him. So what was interesting about this is he was studying this company called Studebaker, which was a conglomerate with multiple pieces. The disclosure on the company was pretty poor. Like there weren't like segmented financials like many of the companies have today. So he couldn't really figure out which was most valuable. And he started looking at this company called STP, which was a subsidiary of Studebaker, and he went to he knew that this product shipped from this rail yard went into STP, so he went to count rail cars to estimate demand, and he saw it was like taking off, and this subsidiary wound up being the most valuable component of the conglomerate, which he figured out partially because of this work. I don't think whether he went himself or he sent an associate to do this work matters all that much. It was like kind of a creative way of trying to answer the question.
And is it true that he would pay people to show up to shareholder meetings because this is obviously pre-internet, right? Like this is where you need to glean all this information firsthand. Would he send people if he couldn't make it?
Yes, I think that as he got older, he started paying people to do a lot of this research for him, because he was obviously capacity constrained since he's one person. So he did do quite a bit of that.
Interesting. So he's absolutely pouring through the Moody's manual year after year after year, looking for these nets. So he's very much a balance sheet focused investor. Can you tell the audience more about what he's looking for and why in these companies?
Sure. So at this stage, he was just looking for really cheap stocks with excess net cash, and for the market capitalization to be trading below that. He was looking for assets that could be quickly converted to cash. Obviously, the bigger the discount, the better. In the first part of his career, he was very, very focused on this. And then secondly, this is a little bit more speculative, but I think it's a big theme of the book, is he was looking for ways to realize the value from the balance sheet, meaning like I kind of read about it early in parts of the book where a lot of the net nets that he was buying were trading as net nets for quite some time. And there needs to be some catalyst to unlock value, whether it was change in management strategy, or an activist stepping in. Because otherwise, if the cash is just sitting there, the stock is not really going to move all that much, typically. So I think Buffett was also very laser focused on finding out ways to create value, because the analytical work of analyzing the balance sheet was pretty easy, and a lot of the work really came from creating the value.
Yeah. Not everyone's perfect, including Buffett. Though he achieved 29% annualized returns in the partnerships, there must have been some losers in there, some lessons learned for Buffett. What were those lessons learned?
Sure. So there's a couple of examples. First I'd point to is Marshall Wells, the first chapter in the book, which wasn't a big loser for him, but he kind of embarrassed himself in front of Lewis Green, who was a investor himself. He owned Marshall Wells too, and he was at the meeting, and he was also a friend of Ben Graham's, and they served on the board of directors of companies together, including Philadelphia and Reading later on. And Green asked Buffett why he bought the stock, and Buffett replied, because Ben Graham bought it, which is actually not the true answer. Buffett had done his own work. Buffett also made a really significant position in his personal portfolio, while it was an insignificant position for Graham. And Green is kind of disgusted at this, and he says strike one, implying that Buffett swung and missed. And then years later, a few years later, when Buffett is trying to raise capital for his partnership, Lewis Green is at the Graham Newman dissolution meeting, since the fund was liquidating, since Graham was retiring, and he says at the meeting, why didn't they try to mentor somebody and have somebody step in the shoes? All they have is this Warren Buffett kid, and who would ride with him? So it made it a little bit difficult for him to raise capital. He was obviously able to overcome that, and successfully raise capital and grow into the world's best investor. And the second example is Cleveland Worthington Mills, where he bought the stock. He wrote about the dividend coverage, thinking that the dividend was safe, and he was quickly proven wrong. They got the dividend shortly after. Stock went down a bunch, and he went to the annual meeting to confront the board about it. How
did Buffett meet Charlie Munger? How did that come about?
Sure. So Buffett was trying to raise capital, and he was at this Ed Davis's house, who was a doctor. Buffett's pitching him and his wife, and Warren doesn't think that Dr. Davis is listening. And then at the end, he cuts him a check, and Buffett's like, well, why? And he says, because you remind me of Charlie Munger. So a few years later, Charlie was in town settling his father's estate, and the Davis sons organized a lunch or dinner for for Charlie and Warren to meet, and that's how they met.
And what was the first investment that they made together, Charlie and Warren?
So the first formal investment is Hochschild Kohn, the Baltimore retailer, but they had some overlap in the names. So in 1962, Charlie started his partnership, which is 3 years after they met. And one of the first investments Charlie made was British Columbia Power, which he put his entire net worth into. He put his entire fund and levered up to buy the stock. And Buffett also owned it himself, so I assume they talked about it quite a bit. Buffett had it as like 11% position. And like over this time, they were communicating about stocks quite a bit. But the first formal investment was Hochschild Kohn in 1966.
And I think it's talked about in your book that retailing didn't work out as planned, did it, for Munger and Buffett, right?
Yeah, that's correct. This was a loser for them.
And why, and what were the lessons learned from that foray?
Sure. So Hochschild Kohn was a department store company based in downtown Baltimore, and Buffett, Munger, and Sandy Gottesman bought it at a like optically kind of sort of cheap price, like a 10 times PE, 0.77 times tangible book. So it looked pretty cheap. The issue was that there was no differentiation between the department stores. So at the corner of Howard and Lexington, where Hochschild Kohn's primary store was at, which was responsible for about 40% of revenue, you make a 360 on the street corner and you see all the competitors. They're all like very similar. To be clear, they're not exactly the same stores. Some were a little better in toys, some were a little better in clothes, etc. But they were similar enough that you couldn't differentiate yourself and build a business that would sustainably earn good returns. And this was happening while Baltimore was declining, so people stopped going to downtown Baltimore on the streetcar. That they were moving to the suburbs. So the suburbanization of the country impaired the value of that location, and it kind of kept declining. And part of the issue was that Hochschild Kohn was not as price competitive in the suburbs as the newer chain stores were. So they were earning mediocre returns there. The cash cow of the downtown Baltimore store was declining, and Buffett, Munger, and Gottesman were able to get out a few years later at roughly cost. I estimate they actually made a little bit of money because of dividends. So it wasn't a big loser, but it was kind of a mistake because Buffett was just like killing the market at this point. So the opportunity cost of Hochschild Kohn was pretty big for them. And I think that in terms of lessons, I think it started kind of like getting them a little bit more focused on the quality of a business. They were kind of I'd include Charlie in this as well, but Buffett was largely a quantitative investor at this point, and I think that this kind of inched him in the direction of the qualitative. I think Munger was quoted somewhere as saying like Hochschild Kohn and See's Candy were big examples of pushing them into the direction of the qualitative.
Mm-hmm. And obviously, See's Candies was just a huge success.
Yes.
In comparison. So you mentioned that one of the most challenging chapters to write and research on was the chapter on Walt Disney, Buffett's investment in Disney. What was the thesis there for Buffett to initially invest?
Sure. So he thought that the film library and the value of the property, plant, and equipment at the parks was worth roughly the market capitalization. So Disney was trading for about $80 million market cap. And Buffett thought, they had this they had the theme park, which had invested capital in it, tangible invested capital, and they had this history of film library, which was almost written down to zero on the balance sheet. And he's kind of looking at it, and I think he's like, all right, it's worth at least this. And then when he invested, the company was actually still rolling out Mary Poppins worldwide, but it was released domestically at this point, and it resulted in the highest earnings Disney has ever had. And I think Wall Street was skeptical that they can reproduce this. So Mary Poppins was like the fourth highest grossing film of all time when Buffett invested, and you just can't count on another one. Disney had a long track record of successful films, but none more Mary Poppins. So the expectation was that earnings would decline. Um, and Buffett was like, fine, it doesn't really matter. I have this film library which is written down to nothing. I have the theme park, and I have Walt, who was by this point a proven figure of creativity, and even though he didn't really care about profits, he was able to create significant value for shareholders. So I think Buffett saw this and was like, "What is Disney worth?" And he's like, "Well, more than $80 million." So he bought the stock.
And so I think you mentioned that Warren flew down to actually meet Disney. Is that right? So
Yes.
what was he asking Walt that he didn't already understand from his own research?
That's a good question. So Buffett remarked to somebody years ago that he still has his notes from that, and I obviously haven't seen them, so I'm speculating a little bit. I think that what he was probably focused on was trying to figure out the overall strategy of the company. So in the book, there's this strategy map for Walt Disney Productions, the company, and it shows how the things fit together. Where Walt had a TV show which helped drive sales to both the theme park and to film, and how film led to the creation of certain rides at the theme park. So it was very, synergy has become like an overused word, but Walt had this synergistic view of the company and how all the parts fit together. And I also think that Buffett just kind of like went there to size them up almost, meaning there was this corporate governance risk with Walt where there was some siphoning of value from Walt Disney Productions to Walt's personal holding company, and on the face of it, it looked very bad. And I actually think it is still very bad, but I think that when he met Walt and figured out he was an okay guy, it made it much more comfortable to invest. And last thing that I should have mentioned earlier, I think he probably spent a lot of time asking about the unit economics of rides. So apparently when Warren and Charlie would go to the theme park with their children, they would spend time talking about like the profitability of rides. So back then you paid per ride, paid an entrance fee and then per ride. And I think they were probably analyzing like how much does this cost, how much revenue, how much people are there. Because Walt was investing so much in the park that the published earnings probably depressed the true economic earnings of the park. And he's probably spent a lot of time with Charlie trying to figure that out, and with Walt when he met him later on.
Buffett was really the detective, wasn't he?
Yes.
In the investing world, he did not cut corners. He went very much in depth. I think not a lot of people appreciate that. And at the time, Disney isn't what we know it today. It wasn't absolutely world renowned. It wasn't as big as we know it. It was still a growth company, right? It was still early stages. So it was absolutely taking a risk. What was in this time period, Brett, 1950 to 1970, was the initial investment in Geico. Did that happen during this time?
Yeah, so Buffett made put the majority of his net worth in Geico in around 1950, and he sold out of it pretty quickly, actually. So he bought it when it was like, I think it was like 6 times earnings. He actually wrote about it in Trade Magazine, which is available online. I looked into it a little bit, and I was like, I don't think I have anything different to say. I have nothing good to add on Geico. And then later he bought half the company in the 70s when it was trading distressed, and then subsequently bought the rest in the 90s.
Well, why did he sell out initially?
So he was a little bit. He was turning over stocks way quicker back then. I don't think he had. I think he was, because he was such a quantitative and focused investor. Once the stock ran up a little bit, he's like, I made my money and bounced.
Cigar butt, right? Exactly. We move on to the next cigar butt, a few puffs, and you move on. But I think there's a lot of significance here in the story of Buffett and Graham once again, because it was Graham who inspired him, right, to invest in Geico. Is that right?
Yeah, so we started doing the work because Graham was on the board.
Yeah.
So, and because Graham was on the board, that's led him to go down to Washington, D.C. to investigate the company, because he was like, when he learned that, he was like so fascinated by it. And, so Graham owned the stock through Graham Newman initially, but he had to spin it off because SEC rules forbade an investment company from owning a certain percentage of an insurance company. So he had to spin it off to shareholders, but he owned it personally, and he wrote in like the Intelligent Investor that it was responsible for like the bulk of his earnings in common stock investing.
Yeah, and there's a lot of significance there because Graham basically invented margin of safety, cigar butt investing, and then Geico just basically turned into a long-term holding. So how did Graham evolve basically after that as an investor?
So it's kind of an interesting question. I don't think Graham ever quite evolved from the quantitative. I think part of it is a function of the time period he lived, where there are a lot of back then the vast majority of assets on the balance sheet of an American corporation were tangible assets, so he didn't really have to evolve. And by the point that he probably needed to evolve, he was retired. So he retired in '56, and I don't think he had the same passion or interest in studying business the way Warren Buffett did. And he just didn't really need to. He earned fine returns with his net strategy. And Geico was like sort of an outlier. He made a big investment in his partnership, and he bought it because he thought that like if anything went wrong, they could just liquidate the company and get their value back. So he was still using the same type of thinking as a general net strategy, just applied a little bit differently. So a little more context on Graham. So he over the life of Graham Newman, he beat the market by 200 or 300 basis points. However, that's excluding Geico. And I kind of go back and forth on whether it's fair to exclude Geico because, in my view, because of the type of investor Graham was, I don't think it's fair to give him an entire credit for the success of Geico afterwards because he had to spin it off to shareholders. It's possible maybe he just like flips it after 50% gain. But I don't know. He obviously deserves a lot of credit for a great purchase decision. But once he outsourced the sell decision to his shareholders as a function of the SEC regulations, I don't give him full credit either. Because I think with Geico, his returns were north of 20%, while without Geico, they were about 15.
Mm-hmm. Warren Buffett never intended to take over Berkshire Hathaway, and I think it's a really interesting story. So let's start with what was Buffett's thesis on investing in the first place in Berkshire?
Sure. So it was just a net. Very, very simple, trading below working capital on the balance sheet. They cash, inventory, receivables. As probably should have mentioned this earlier, net nets are when current assets versus all liabilities is more than the market capitalization. And Graham uses as a proxy of liquidation value. And that's what Berkshire Hathaway was. It was a net and trading cheap, and that was it.
So he's investing in a company in which it's in a declining industry, right? Textiles in the U.S. Absolutely not a growth company, and I think the investment doesn't meet his expectations, right? At first, Buffett. Can you explain?
Sure. So, the performance of the company is just not good. They're getting kind of crushed by international competition. Also, quick plug. Adam Mead wrote a great book on the history of Berkshire Hathaway, the actual corporation, which goes into like great detail on this stuff. But generally, competition was just eating their lunch, and they were earning mediocre returns. And then a few years after Buffett's initial purchase, so he bought it in 1962. In 1965, he ends up taking over the company. And the reason why he kind of goes about this is because he's talking to the president of the company, asking him what price he's going to tender at, and they agree to a price. And he gets a letter a few weeks later, and it's about 1/8 short of what the price they agreed upon. And Buffett's so angry that he buys as much stock as he can, takes over the company, ejects the president, and changes management, and eventually becomes CEO and chairman.
That's so interesting. So it really was never Buffett's intention, but he had beef with the president, right? And he ended up taking over the entire company and transforming it into the conglomerate it is today, the permanent investment vehicle. Brett, what were some of the things that at the end of researching and writing the book that you learned that you said, wow, like, I would not have known that if it weren't for all the research I put into the book?
Sure. So there was a lot of stuff on the company specific stuff that I didn't know, like learning about the history of Walt Disney Productions, learn even American Express. Like there's a lot of the minutia there that I hope it can properly conveyed. Like I think the story of the salad oil scandal is like so fascinating, and I hope people enjoyed reading that stuff because I love researching it.
Tell us about it. Tell us about the scandal.
Sure. So the salad oil scandal was kind of a well-known fraud, but there's some details to it that I didn't think were like particularly well covered. For example, actually, I'll take a step back, give a higher overview for those who don't know. So, American Express, company that everybody knows today as a credit card company, had this field warehousing subsidiary where they just basically guaranteed loans for salad oil, and they had done business with this figure Tino DeAngelis, who they never should enter business into because he was clearly a bad guy. He was a total fraudster. Like he got arrested before. He got criticized publicly by like a senator as being like a disgraceful figure. There was no reason for them to ever enter in this business, especially with him. But they thought it was like free money. It was easy money, and he was a big client. And so they guaranteed his loans, and he was essentially just running a big fraud. And American Express was actually alerted to this fraud, meaning they got like an anonymous call saying like there's tanks that are supposed to be filled with oil and they're filled with water. They go out there, they test it out, and there's like actually a trap there where like the little bit of oil that's there is held in like this small compartment within this big tank, and the testing device is dropped right into there. So they go out, they're like, oh, it's fine. And then later on, there's like a point when they learn that there's too much water there. Like so it's supposed to be like less than 1% because of condensation. And there's way more water in the tanks than supposed to be. And they're like, well, we're covered. It's fine. Like there's enough oil in the tank to cover us. Of course, like that one tank had the most oil of any of the tanks there, and the rest were like basically just water. And Tino starts like getting even more aggressive with this fraud. He tries to jack up the price of the oil because he has like a levered bet on trading. American Express employees are like invested with him. So there's a huge conflict of interest, and eventually Tino just starts writing out the receipts himself as American Express. So he's like guaranteeing loans as American Express to himself, which is like just obviously fraud. And it kind of like all crumbles because the price of oil goes down. And this leads to Tino declaring bankruptcy of 3 or 4 days before JFK's shot. And American Express stock like doesn't really react, and for like the first couple days, like goes down a little bit, like 3 or 4%, and then JFK gets shot, the market like plummets, and the Dow actually ended up that month, but American Express's stock was like cratered because of the scandal. People started realizing it was way worse than people think. The potential liabilities are like more than like the cash on hand and the equity value of American Express. So the stock is like puked, and Buffett actually doesn't buy for like 4 or 5 months. He starts doing a lot of work, and by the point that he starts buying, the liabilities were kind of like ring fenced. He could handicap them, and that's when he stepped in.
And when he stepped in, obviously there's a drawdown in the stock price of American Express. So this is like the sweet spot for Buffett. He completes his research. He steps in. Did he take an activist role at American Express?
No. So it's kind of interesting. Well, I say no, but it's kind of interesting. He sends this letter to Howard Clark after he accumulates a decent stake, and knows about that's 15-20% of partnership assets at this point. Not that much of American Express's equity. So he was he was a big shareholder, but it wasn't like he had like 10% of the company. He eventually bought 5%, but that was a few years later. And he writes this like letter to Clark that was very dismissive of the salad oil scandal. He's like, you need to like forget about this. You need to take care of the people who are upset with you. Just consider it like a lost dividend check. And it was very like gracious, nice letter to Howard Clark. And I don't view that as like activist in the conventional sense, but it's a little bit of like soft activism because Howard Clark had like no friends at this point. People probably thought that he was like an idiot, and getting some validation from Warren Buffett, who wasn't well known, but like was probably well known enough that it meant something, was meaningful. And Buffett volunteered to like testify on his behalf, saying like, you got to pay these liabilities, because shareholders didn't want them to pay. Other shareholders didn't want them to pay, and it was important that to Buffett that they do pay. And quick note on that is the reason why it was so important because the people who held the loans, who provided the loans to Tino were banks, and the banks were sellers of the traveler's checks that were American Express's prime business at this point. So American Express had to keep the banks happy, and Buffett knew this, and so did Howard Clark, because Howard Clark never absolved himself of responsibility. He stepped up in a big way, and Buffett supported him.
And obviously, American Express turned around, and I think it remains. Is it his longest running holding for Berkshire?
No, so he sold the stock in the partnership in '68 or so. He bought a little bit in Berkshire in around this time period as well, but he sold it as well. He actually did not step in because he was not a fan of the CEO. That I don't know if it was two CEOs after Clark, but there was one CEO that he didn't really like, and he wound up buying the stock in '93.
Okay, so he rebought it in '93, and it's remained a holding. What other interesting details were you able to tease out through research where you thought, wow, like I didn't know those details?
Sure, there were a couple things that I found in these. There's actually a library. There's actually a host of boxes and documents related to Walter Schloss and Ben Graham at Columbia University. And there were a couple of documents in there that I thought were like super interesting. There was a lot of communication between Graham and Buffett, or Graham and Schloss. There are two things in particular that I thought were like really interesting that didn't make it into the book. First, what was there was a lot of correspondence between Buffett to Graham that was, I don't want to say Graham was like dismissive, but it was not like the flowery praise that I expected. Like Graham was like a little short in responding. He spelled Buffett with like one T instead of two. I think the kinship started when Buffett went to Graham Newman. I was a little surprised at this too. Some of it could just be Ben Graham's personality, who apparently was not an overly complimentary person, which I'm not sure about, but that's what I've kind of read. And it was just kind of weird and like almost sad to see how desperate Buffett was to impress Graham, and Graham's like brushing off a little bit. And then the second thing that I came across, this was very early into the partnership, was there was a letter from Buffett to Merchant National Properties that was a fairly abrasive letter, implying that there was a little bit of like insider dealing between related companies that was unfavorable to shareholders of Merchant National Properties, and I was kind of surprised at the tenor and tone. It's funny. I tried to research a little bit more to figure out whether I thought Buffett was right or wrong, and I couldn't really figure it out because I actually wanted to write about the company in the book, but I just couldn't get enough details. And so I was surprised at the level of abrasiveness in the letter, but what was funny is that subsequent letters show that they actually became very good friends. Like Buffett became friends with Leonard Marx, and like there was like recommendations swapped on like certain like charities or clubs, stuff like that. So it's kind of funny to see that.
Yeah, for sure. And going back to Graham, Graham was hesitant to even hire Buffett in the first place, right?
Yeah, it wasn't because anything was wrong with Buffett. Buffett was actually the first person to get an A+ in his security analysis course at Columbia, but there was quite a bit of anti-Semitism on Wall Street at the time. It was very hard for Jewish people to get jobs. So Graham didn't want to hire Buffett because of that, rather than anything wrong with Buffett.
So it sounds as though there may be a sequel here for your book. If you were to land that interview with Warren Buffett, if you were to fly down there to Omaha and actually meet him in his office, what would you ask him?
So I'd ask a couple of fairly selfish questions. First is whether I'm right about Philadelphia and Reading being the inspiration for a permanent capital vehicle. Second, I'd ask him about what that meeting with Walt was like. Third, I'd prompt him to release more of his files to the public domain, because I think that they'd be a great resource. And then kind of like shifting to Berkshire Hathaway, I'd be very curious on how he thinks about compensating managers and keeping them happy. Like my understanding is there's some bonus system depending on the subsidiary, and I want to hear how he thinks about that and what factors he's focused on. Like, what does he compensate on? The other thing related to this is apparently when you make if you're a Berkshire Hathaway CEO of a subsidiary of Berkshire Hathaway, in your capital budget plan, if you request like more capital than expected or something, there's like a capital charge to it that impacts your compensation. So I'd be curious in learning about how that works. What was the inspiration for this? Like, did he come up with himself? Like, how did he figure this out? And whether he thinks there's like drawbacks to it that he's run into over time. And finally, I'd ask a lot of questions on some stuff like I in the 70s and 80s. Like there's one investment he had that called like Source Capital, which he was involved in with somebody else that I wasn't able to find all that much detail on. And I'd kind of be curious on that. Final question I'd have is if there's anybody else I should study. He's mentioned like some figures over the years that are like super interesting.
And who are those figures?
I mean, Harry Bottle is one who helped him turn around Dempster Mill, and I think a couple other companies. Gurdon Waddles, who was an Omaha businessman who had like these like Russian nesting doll companies where one company owned another company and owned another company, and I'd be curious on like who else he admires that is like not really known about.
So occasionally at the annual shareholder meeting, investors will get up and ask Buffett, if you were to do it all over again, could you still achieve those 50%, pre-partnership returns as you did then? And he says yes, but he doesn't go into much detail. How do you think he would go about it today?
So I think that he would be focused on very small illiquid securities, way off the map. Liquidations, special situations, arbitrage opportunities, maybe using a little bit of leverage. I think he was doing a lot of that stuff in the 50s and 60s, and I think that's exactly what he would be doing today. I'd be curious on his thoughts on whether it would be all in the U.S. He's made a remark before that it wouldn't all be equities. So he'd be doing bonds, preferred, stuff like that. I think that in like the nanocap land there's just a lot of inefficiencies that he would seize on. And he points out like there'd be very fast diminishing returns to scale. And even his records kind of an indication of this, where pre-partnership, when he had nothing but his own money, he was doing 50-60%. And then in the partnership, he did 30%. And then in Berkshire, he's done 20%. So his returns have declined each subsequent decade. Actually, I need to fact check that, but generally they've declined. I mean, 50s were the best, 60s next best, 70s so on. I think that he could do it today.
Yeah, and I think another reason for the success is not just maybe the stock picks themselves. Like obviously, you'd focus on e-liquid smaller companies, but it was also concentration in the portfolio itself. Can you talk about how much position mattered back then for Buffett?
Sure. So Buffett frequently had two or three stocks north of 50% of the portfolio.
Wow.
I I tried to lay this out in the conclusion a little bit because this was actually a surprise for me is how concentrated he was. Like I knew about American Express where he eventually put 40% of the partnership capital into it, but I didn't realize how consistently over the course of his career he remained concentrated. And I think like American Express is like a pretty interesting case study of how he thinks about risk management, where he started buying the stock after the liabilities from the Saudi oil scandal were ring fenced, but he doesn't scale the position for a couple of years when you start seeing the credit card business really the charge card business, so technically it wasn't a credit card, really take off and see that it has really good earning power, and this leads him to scale the position as the risk from the Saudi oil scandal declined, and the quality of the charge card business stepped up, and this leads him to increase the position. So it's pretty interesting. The other thing I'd point to is that he, at least in the partnership, he really didn't make these north of 20% positions unless he had control, like Sambor Map, Dempster Mill. That was a risk mitigation technique for him. That I was kind of rereading my book this weekend. I'm like, oh, I'm not sure if I made that point as clearly as I needed to. Where when Buffett was in position to control the capital, the investment was now de-risked because Warren Buffett controlled the capital and not person A, who might be a mediocre capital allocator, or even worse.
Which is crucial, yeah, for risk management purposes. Buffett mentions that there's two things he really thinks about when he reflects on stocks. One, errors of commission. The losers that end up losing money, and then errors of omission. In those early days between 1950 and 1970, what are some of the errors of omission where with the stocks that he researched, he passed up on, but ended up delivering some amazing shareholder returns?
Oh, so that's a good question. I don't think I have a good answer for that. I don't think I have a great answer for that. It's funny because there's a lot of times that he talks about stocks that he bought back in the day and didn't and sold out quickly, like Disney, but he actually earned a better return than Disney did. So it wasn't really a mistake in that sense.
Opportunity cost, right? He seized on something better.
Yeah. Like I ran the numbers and I was like, oh, Berkshire actually outperformed. So I don't think this was like a mistake in the conventional sense, even though Disney did so great. But yeah, that's a tough one. I don't think I have a great answer for that.
Is it true, Brett, that you met Charlie Munger? Did you meet him?
Yes.
Tell us about that. Tell us about the whole experience and Charlie.
Sure. So I was my current boss, Su Chen Tan, introduced me to Peter Kaufman, and Peter, who wrote Poor Charlie's Almanac, which is a must read, generously invited me out to California to tour his company and meet Charlie, and of course I jumped on the opportunity. So first I'm very grateful to Peter for inviting me out, and for Charlie for hosting me. So one of the things I want people to realize is the meeting with Charlie was actually like kind of, it was unrelated to my book. It wasn't like a formal interview or anything. Charlie, over the final years of his life, spent a lot of time with people like me who were fans, and had them over for lunch or dinner or something like that. And it was very incredibly generous, charitable act on his behalf. And I was lucky to be one of these people. So I went to Charlie's house for lunch. He is very funny. Like I think people could tell at the Berkshire meetings he's funny, but I don't think they appreciate how funny he is. He's very kind. He has a remarkable memory. So I asked him a couple questions about British Columbia Power and Hochschild Kohn, which are two chapters of my book, and he answered the questions. It was funny because I asked him about Holster Cone because I was like, one of the things I read about in the book, which I do believe, even though Charlie tells me I'm wrong, is that they're too harsh on themselves. Like, it was a mistake. They didn't make money. They got it wrong, but it wasn't as big a mistake as they said. And one of the reasons why I think that is because the MLK riots in 1968 kind of destroyed the inner city of Baltimore, and it increased the population exodus from downtown. If this didn't happen, I think they would have earned a better return. And Charlie told me I was wrong. He's like, you're overstating it. But he was really funny and gracious, and I was there for like I think 3.5 hours. I had 40 minutes alone with him.
Wow.
And people say like don't meet your heroes, but they should. Charlie lived up to all expectations, and I'm very happy he did that for me. I met him 2 months prior to his passing. He's very sharp.
Well, that's just an amazing opportunity. What questions did Charlie ask of you? What was he interested in?
So he asked just some basic background questions. He asked me how I invest. At the time, I was not an analyst at a fund, so I was just investing my own money. And I mentioned like I had over 50% of my money in one stock, and he's like, that's the right way to invest, or something to that effect. And we spent a little bit of time talking about like the pressures of investing other people's money, because one of the things that he brought up a couple times was the fact that in the early 70s he had a big drawdown, and he's like, I knew my stocks were good, like the intrinsic value was way higher than the market price, but my partners couldn't bear the drawdown, and it was very painful for him. With hindsight, I wish I asked more questions on like how he overcame that, like over time, because post his partnership, he continued to be an incredible investor. But those were like most of the questions, like what I was doing now. And
Yeah, well, what was that percentage drawdown at the time in '74? It was significant.
yeah, two years in a row of 30% drawdown, so cumulatively over like about like 70%.
My goodness, yeah, just overcoming that, staying in the game, right, and just growing exponentially is it's a personal toll on someone. Charlie's just so interesting. Did he try to convince you the other half of your portfolio to invest it in Costco? Like, what did he say?
No, no. He gave no investment advice
Yep.
to me, which I would have received obviously, but I would never ask. Yeah, no. He did talk about the benefits of Costco a little bit, not too much. Yeah, he spent a lot of time actually talking about real estate because he had a lot of investments in real estate, apartment complexes, stuff like this. And hearing him talk about it and the way he thought was really interesting.
That's really interesting. Who's surprised you? Like, who's reached out to you since the release of the book, Brett?
So I'm surprised at everybody who reaches out. To be honest,
It's fun, right?
it's great.
Like you have fans.
I put an email in there because I was like, because one of the things I tried to do, and this is for everybody to judge whether I was successful, is I tried to have differentiated stuff. Like I didn't want to write about anything Buffett did, so I put in the email. I'm like, if you can't find these documents, I'm happy to send them to. I get a lot of like complimentary emails from college students, people who are not in finance, to some pretty successful investors who I don't think they want me to name them about it, and like even like follow up questions, which I love. So I'm always surprised that anybody reaches out, and I actually feel bad because I've read so many good books over the years, and I never send those emails to them because I don't think they want to hear from me. But now that I'm on the receiving side, I'm like, oh, maybe I should be a little bit more complimentary.
Yep. That's just great. And so we were kind of talking about a possible sequel to Buffett's Early Investments as you get more research coming in. But what maybe else is there in the future for you? Is it a book project? Is there something else on maybe a different figure?
So I don't know. I'd like to do something that is, if I were ever to do something again, I'd like it to be differentiated. I feel like there's a lot of business history that's not well covered. One book that I love that does a good job of this is Jeff Graham's Dear Chairman, which is an extremely well written piece of work and talks a lot about business history. So if I were to do something again, it would try to be something like in that vein where I thought I had some differentiation. Right now I'm an analyst at an investment firm, which I'm enjoying. So right now I'm plugged away at trying to become a better investor, but maybe someday I'll do something else.
That's just awesome. Well, again, like thanks for doing all the research. Because this information is hard to get, and of course, compile and summarize. Thanks for publishing the book. Where can people find the book?
Sure. So they can find it on Amazon. That's probably the easiest place. Barnes and Noble's website has it. I don't think it's in stores yet. You can also buy it directly from Harriman House, my publisher. But Amazon would be the best source.
Okay. Well, this has been a lot of fun, Brett. Thanks a lot.
Yeah, thank you.